Good evening, friends. I am Ramneek Singh Johar. Welcome to my channel. I am a strategic investment advisor for Motilal Oswal Group, and I am working as a freelancer, and I am a stock investor also. So I would like to discuss a very important theory of blowing back the profits of the stocks. What happened? For example, in the month of April, I had invested 1 lakh of rupees for a particular stock price, and the but average stock price is rupees 769 rupees per stock. And for by investing 1 lakh of shares of the stocks, I bought 137 quantity. Now, from April to June, the stock value increased from 769 to 1470, almost double the price. So profits are double. So what I did, out of 137 number of stocks, I sold out 37 number of stocks at the value of 1470 rupees. Now I have the profits about ranging from approximately 24,000 rupees. So instead of reinvesting this particular money, 24,000 rupees, into some other particular stock, or redeeming it into my bank account, saving bank account, what I did, I reinvested the money into a particular stock, that is principal value of the stock. This is known as pulling back of the profits to the actual value of the stock. That is the of reversal theory of plowing back the profits into its principal value. In a nutshell, instead of investing it into any other portfolio or diversified stocks, I invested into that particular stock. And what is the reason, you will be asking me, for doing this? Because I could have made a profit 24,000 rupees. I could have redeemed it into my bank account or invested into a particular next stock. The reason behind this is that this will increase the financial value of the principal invested stock. For example, there are two coins of rupee 1 and 1. There is 1 rupee coin. If I add to another 1 rupee coin to this, there will be the two coins, and gradually, for example, I have a 100 rupee note. If I add another 100 rupee note, there will be, after a particular time, there are 1 plus 100 plus 100 is 200. I did the same theory, practiced the same theory to this. So what happened? Now the stock value was approximately 1100 when I reinvested into the same stock. Now the stock value is going about 1100 rupees approximately. Now 1100. Now in the month of July, it has again increased the stock value about to 1370 rupees per stock. So in the long run, if you are investing your short term money into long term perspective, this will give you give you the increased principal value in the long run, and this will also increase your asset value financially, and nobody can snatch you your strong asset value towards a particular stock. Because what we people do, that we observe the uh, behavior of a particular stock and how this particular stock is performing, that is day by day, intraday, maybe after 2 days, weekly, monthly, or maybe within a gap of 3 months or 4 months perspective. So if you are investing your short term money and you want to gain more profits, what you can do by selling some amount of the stock and reinvest it into a particular stock. This is known as the reversal theory of plowing back the profits into the main principal amount. And this is my own uh, research within a time gap of 6 years, because when I entered into the stock market uh, investment earlier in the year 2020, so within a experience and research, so what I have learned that it will also increase the monetary financial value, and you will have the strong financial asset value over a period of time. Now, so what has happened now? I have again my stock value 137 shares. I have again has come into my account. Now it's my option whether I have to keep it for another 1 year, 2 year, 3 year, and this will actually grow the value of the stocks. So, in a nutshell, we are judging the company's behavior of a particular stock in a reciprocal way. The companies also, the big companies, they also uh, observe the behavior of the consumer, but what they are up to and how they are, what they have in a particular mind in a in a particular consumer. Suppose I'm keeping a watch on my portfolio list through mobile app or on your computer daily, weekly. So the companies also will observe the behavior of the customer or the consumer, whether they want to keep the stocks short term, mid term, or higher value. So another example is that we suppose we have the two doughs. We all eat rotis. Indians have a habit of eating Indian meal chapatis. We are making a particular dough, right? Particular dough in the afternoon of. So after making a dough, we are making the desired quantity of chapatis, and there is always a possibility that's a particular amount of dough which is left over. Instead of throwing this particular dough, we keep it, preserve it, and add it in the evening for a dinner. So if we combine these two doughs, so this can be utilized for the evening thing, evening dinner meal. So my point of judgment is that understanding also that instead of plowing back the investing the profits, short-term profits into another stock, just keep it and observe the market value and then invest it. So I did the applied the same theory. And another example is that suppose in the kitchen we are preparing a gravy or something. If the gravy is thick, you can always add water to the quantity of the gravy to increase the quantity of the gravy. In a commercial kitchens, what we do, but this is the similar thing. What we do, what I did, purchasing a 137 or 38, 130 shares, I sold out the some 25% of the shares and made a profit of 24,000 within a gap of 3 months. So instead of reinvesting 24,000 into another uh, stocks, diversifying the stocks, or uh, redeeming the 24,000 into my bank account, I reinvested into the uh, same stock principal value. So this is known as the reversal theory of reinvesting the stock into its principal value. So this is my self-made theory, and uh, I may apply for this copyright or a patent for this, and I will also share and with this to the stock financial companies in India also, as well as US markets also, if I get the approval. So that will be okay. Thank you. Have a nice day. Welcome to my channel.